Good afternoon. This is Barbara Mayetta. I am with 12 Points Wealth Management. I'm a wealth advisor here. And I work primarily with clients who are approaching retirement or early in retirement. And I'm really passionate about working with people in this phase of their life because they have more knowledge, more experience, more wisdom, and more confidence than they do with any other phase of life. And I love challenging them and helping them explore their opportunities to build more purpose into their retirement. And I am also the proud owner of a hybrid life insurance, a hybrid long-term care insurance policy, which I purchased through Linda a couple of years ago. And so today, Linda Thalheimer is with us. And I'll let Linda is a national expert in long-term care, and I will let Linda introduce herself.
All righty. Let me turn the page here. Oh, there we go. So hi, everyone. I am Linda Thalheimer, and I have been specializing in long-term care insurance for over 25 years and very passionate. I am licensed in almost every state and can offer almost every product. And I can certainly quote on every product. But the idea is all about education, understanding the options that are out there, understanding the true risk of long-term care, and and then figuring out the cost benefit of the insurance as well as the value. Because there are a lot of things we buy in life, not just because of the value, the financial value, but because of the value to our families and the people we love. So I love working with 12 Points. I believe that long-term care is a tree and a financial forest. So working with quality advisors who know the forest really well, it allows me to help people place the right long-term care tree in their plans. All righty. So let's talk about long-term care insurance. So now when most people think about long-term care insurance, they're thinking 80, 85, 90, but I think it's really important to understand that we're healthy until we're not. And we are not surprised when we hear someone has a car accident or cancer or Lyme disease or COVID. And we're sad, but we are not surprised. And we are not surprised even when people get diagnosed with illnesses like Parkinson's or MS. Again, once again, we are sad, but we are not surprised. We're only surprised when it's us or our loved ones. And so what I hope to try to do is to help keep everything objective so that you can make objective decisions with regards to risk and protection. Now, when we think about the aging population, we are not surprised when an 80-year-old or an 85 or 90-year-old needs some help in home care, assisted living, adult day health, or even hospice. And all of these settings are extremely expensive. So living a long life is a near certainty, and planning for it is really now a necessity. So what is long-term care? What is the actual definition? Well, the definition for insurance companies, and we're talking about qualified long-term care benefits, and that qualified mean it has tax incentives in those policies, is that it requires you to need help with two daily living skills. And those daily living skills are bathing, dressing, toileting, transferring. That means transferring from a bed to a chair type of transfer, indoor transfers, continence, and feeding. Feeding is not cooking meals, but typically just, table to mouth type of thing. And the physical assistance only has to be a standby as opposed to actual touch. In other words, if somebody is unbalanced and at any moment they could be tipping over if they're picking their foot up to put on a pair of pants, or they're in the shower and there's a concern of slipping and they have to be within an arm's reach, then that is considered part of physical assistance. Or a severe cognitive impairment requiring substantial supervision. So this isn't when people don't need need help with like financials or their calendar, this is when they really need to be supervised because we don't know what they're going to do if they're left alone.
Linda, how does one get start the claim policy? So I think I can no longer transfer and I can no longer bathe for myself. How does one go about getting qualified for long-term care benefits?
Certainly, certainly. Well, the general public will just call the insurance company to initiate their claim. Our clients call me when they initiate a claim. And just so you know, I do now have a full-time claims department. So I have an associate who runs all of the claims to make sure that when people call, because this is not a good time when people go into claim. This is a sad time. It is when you need help, and nobody wants to need help. And it's a change in lifestyle for the person who goes into claim as well as for their loved ones. So this is a hand holding time. And so I now have somebody who I can say that if I was on vacation somewhere, there would still be somebody there to be able to hold our clients' hands through the claims process. So that was really important to me because I don't believe that insurance should be transactional. I sell promises. I want to make sure those promises are being kept. So yeah, so that's how that works. We try to make it very easy on people. Once they qualify, we identify what kind of documentation they need, and it's not difficult documentation. It's basically medical records, information from their caregivers, and that goes into the insurance company, and then they can make decisions. Some of them will do a phone interview to just review all of the issues. So not a difficult process. It can be time consuming, but that's why it's always nice that if you need help, there are people who can help you.
Great. Thanks, Linda.
You're welcome. All right, so we're going to talk about statistical utilization of long-term care, but I want to remind you that statistics are a funny thing because, for example, we can look at the average use of care, which is 2.3 for males, 2.6 for females, 3.8 if single. Okay, but and about 40% are 2 years or less, but 16% still use 5 years or more. So this is a U-shaped curve as opposed to a bell-shaped curve. So, for people who don't have a lot of money, we stack it towards the 2 years or less to make sure that they're well covered. And for those who have more money, we can protect for the longer risk of 5 years or more. All right, let's talk about cost of care. And this is terrorizing. It really is, because the cost of care is very expensive. It's $40 an hour with a minimum of a 4-hour shift, which means that you're $4,800 a month in cost, even if you just needed an hour and a half of care. So this is what happens with people who don't have insurance. They say, I'm not going to spend $4,800 a month for an hour and a half of care. I'll do it myself, right? So the family members come in to try to do it. And it's the beginning to the end of home care because the families get burnt out. And as soon as that person has their first hospital stay, they realize, oh my goodness, I didn't realize how tired I was. I cannot go back to that schedule. And that person never comes home again. They go to an assisted living or a nursing home, and the estate is just withered away. So having a minimum at least of 4 hours to cover you on home care is very, very important, not only financially, but to enable you to stay at home longer and better.
And
Now,
Linda, before you leave this page, Linda, I just wanted to comment here, and Linda and I get together and compare notes on our parents quite often. And I'd love to throw out real life experiences here. I have two parents who are both 95 years old, turning 96 within the next couple of months. Both of them by April will be 96. And Linda also has a father who is even older. Mother is a little younger than that. I think your father is 98 now.
he's 98. My mom is 90. Yes.
90, yep. And boy, these people just keep living. Now, my parents unfortunately don't have long-term care insurance, so they are unfortunately for them spending down because they've been paying these rates here. They've only had care since they were 92, but what I also found while we tried to keep them in their home, they just in the last 2 months have gone into a long-term, excuse me, a assisted living facility. But we tried having them with people at home helping to take care of them, but they really needed someone in the morning when they got up to help get them dressed, get them, cleaned up, get them started with their meals, and they needed somebody to do dinner, and they eat dinner late in the evening and to get them settled before going to bed. But you can't buy 2 4-hour shifts, one in the morning and one in the afternoon. The agencies that provide this don't, first of all, they don't like 4-hour shifts. They want it to be longer. So we ran into all kinds of trouble trying to even figure out how to reduce the cost. During the case of my mom, she didn't want somebody in her house all day. So, just trying to get all of that to work out and in a less expensive mode was extremely difficult.
Yeah, yeah, no, absolutely. And sometimes assisted living feels more independent than home care for exactly what Barbara said is that a lot of people just don't want somebody in their house all the time. And in assisted living, they're in their own apartment. The aide comes in and then the aide leaves. The aide comes in, the aide leaves. So there feels like a greater sense of independence oftentimes in assisted living. So, but you can see that if someone was to stay at home, it gets pretty expensive when you start looking at 24-hour care. And assisted living is typically at least 2 times the monthly home cost, and it can be much more expensive than that, especially with dementia. You're usually looking at about 14,000 for dementia. So now there's another aspect to long-term care that people don't think about, and that is long-term care insurance gives a direction to hiring caregivers instead of using family caregivers. So you basically said to your family, I don't expect you to care for me. I have this policy. I expect you to hire people, right? And that can take a lot of burden off of children. And oftentimes, when people go into care, children have different perceptions of who should be providing the care, whether it's the one who lives locally, it's the one who's not married, there are so many subtle rules that families decide on who is the one who has to be the caregiver. And by having the long-term care, that goes away. And the direction from the parent is, you're not providing my care, we're hiring caregivers. The other thing is that insurance makes long-term care easier to spend because it feels like a gift when that money comes in. Nobody asks, how much did this policy cost? They only feel, oh my gosh, look at all the money coming in. Now we're going to show you the cost benefit. So it is a cost benefit. But even on that emotional level of that money coming in, it's a real feel good, right? So when that money comes in, because it feels like a gift, it allows people to spend more money because they think, oh, I have this much money that I was going to spend. Oh, I have this much money over here. Now I can go to a nicer assisted living, or I can have a private aide coming into my assisted living, right? So it super helps on that activity. And it also gives you greater flexibility to travel and visit children. Because when you visit your child, you don't think about bringing a caregiver, but you do when you have a long-term care policy, because that caregiver that you use that you're being paid for in your home setting, you can go in any state and hire aides in any state to provide your care. My mom, when she visits my brother, she's not going to have them assist with her care. So we hire a caregiver, and the caregiver goes out when she's visiting my brothers. And we also use caregivers in hotels when I travel with my parents. So we used to travel, once a year. And by having caregivers come into the hotels, it made it a vacation for everyone. So, it's not a big deal to help someone toilet, during the day or put them to bed at night, but it is a big deal to try to shower and dress and all that in the morning, because then once you get them done, you have to go back and get yourself dressed and ready. And basically the whole morning is gone. So knowing that you have a funding source to bring a caregiver to travel with you or to be in that spot where you are traveling is huge, because most people aren't going to say, oh, I'm going to spend another $4,800 on my vacation. And this way it's already covered with your long-term care policy. So let's calculate the cost of care here in Massachusetts. As I said, $4,800 a month, 2 shifts, $9,600, assisted living on average about $8,000, dementia units at least $2,000 more. And these numbers are low depending on where you are in the state. If you're Framingham and out, these are more realistic. If you're Natick, Wayland in towards Boston, you're looking at a whole lot more. It's not unusual to find $14,000, $15,000 assisted living settings. Now, we're going to talk about the statistical risk of 4 years of care, but no, certainly it could be more. And we're estimating a 5% inflation. 5% has been pretty consistent with the assisted living settings. Home care went crazy during COVID, increasing as much as 24% nationally, and it started to settle down. So I hope that it goes back down to about 3% for home care, but to be conservative, we're using 5%. So now if we look at the cost of 4 years of care today, we're looking at $413,800. And in 15 years, looking at $827,000. And in 30 years, we're looking at $1,655,000. So this is a lot of money. This is more than the college educations, right? So this is a scary number, which is why it's so important to try to leverage your money so you can have more available to fund care if it should be needed. So let's talk about to fund your long-term care. To fund 60% of your long-term care in assisted living in 15 years, as we said, the total cost is $827,500. If we take 60% of that, so that we're co-insuring, we're not saying the long-term care is going to cover everything. We're saying the insurance is going to cover 60% and you'll take 40% from your investments. So that's just under $500,000. Now, if you were to self-fund, you would have to put aside $238,825 right now and earn a 5% average annual return. And we're not even talking about the taxes on your gains, right? A traditional policy, you could pay in $5,386 annually, and which would be $80,790 over 15 years and $134,650 over 25 years. Certainly a lot less than you would have to put aside if you were self-funding. And a hybrid is a policy in which shortened payment periods work most effectively. So in other words, you can pay up the whole premium in 10 years or 5 years or even in a single pay. So if you were to pay $12,226 a year for 10 years, and there is a death benefit if the long-term care is not used, you would be able to generate this $496,500. So the idea of this slide is to help you appreciate that self-funding, even for people who say, I can self-fund, may not be the best idea, right? Because I don't know any wealthy people who say, I don't want a discount. Please let me pay full price, right? Okay, now we want to think about what does health insurance cover? Doesn't health insurance cover some long-term care? Well, the truth of the matter is health insurance does not pay for long-term care. Long-term care is defined as care that goes beyond 90 days. And so the first 90 days can be covered by health insurance, Medicare, and Medicare supplements. But after 90 days, you're on your own. Now, that being said, there are a number of long-term care policies that will pay on that first day of care as well and cover those first 90 days. But there really isn't anything out there that's paying for long-term care, more than 90 days of care. Now, the next question is, well, doesn't the government help us? Isn't there anything that the government does? Well, they don't help you until you don't have money. So what happens is the government says, yes, we will fund you, but you have to do a spend down of your assets. And if you are single, that means spending down to $2,000. If you live in a home, your home will be attached. When you're no longer in the home, they take the money from the home. So they can force the home to sale. So that's not a lot of money you get to keep before Medicaid will help you out. Remember, Medicaid is financial aid. And if you think about those last 3 letters, AID, it's when all investments are depleted. So a couple spends down to $157,920. So it's a very small number to have protected. So So basically, you're paying for long-term care on your own. So small policies still have value. How many of us have gotten to a register and we're buying an article of clothing, for example, and the register says you got a 25% off? And we are smiling all day long. We saved $10 and we are happy. Imagine if you were saving $100,000 or $200,000. It is hugely valuable. Small policies still have tremendous value and they can protect your home. So we'll talk about that. So government incentives. The government wants us to have long-term care insurance. They do not want everyone on Medicaid. So what are they doing? They're incentivizing it by saying the premiums can be tax deductible through your HSA accounts, if you're self-employed, or if you have a C Corp. Now, there are age-based limits, but and you can go to my website and see what those actual numbers are. But the idea is the government wants us to purchase long-term care, and they're willing to give us a deduction on that premium to make it tax deductible. And then the benefits are going to be received tax-free. So it's a win-win situation. Now there and I feel like I'm missing a slide on Mass Health, so let me just quickly go over Mass Health lien protection. In Massachusetts, and we're the only state that has this, we have something called Mass Lien Protection. And what it says is if you have a qualified policy, which is a traditional policy of just 2 years and $130 a day, then your home is protected. So if you have a catastrophic situation and you need to spend down on Medicaid, they'll put a lien upon your home, but when you die, that lien is lifted and that home returns to your estate. So it's a legal way of protecting a tremendous amount of money in your home to leave to your heirs.
Linda, along those lines, so a lot of people on this today won't be from Massachusetts. Are there other states that have similar benefits?
Yeah, for some reason your speaker went off, but yes, in other states we have what's called partnership. And this is a dollar for dollar protection. The vast majority of states have partnership, which means that if you are collecting $5,000 a month, $5,000 from your estate. So if you have a $500,000 total benefit in your long-term care, you get to protect five. Just went off.
Yep.
Your voice just went
So
off.
yeah, can you
Yeah,
pull
I'm
back
sorry.
up the presentation? You lost that also. Give Linda a second here. And let me
Oh,
just
that's
point
so
out to
strange that
folks
happened.
that if you have questions, please use the chat below and Linda can answer questions at the end. It looks like we'll have plenty of time for that. So don't hesitate
Yeah.
to give us some questions for the end.
Sure. I so apologize about that. That's very strange that my internet went out for a second there. So yeah, so in other states we have what's called partnership, and partnership is dollar for dollar protection. So if you want to say, I want to guarantee I can leave $1 million to my heirs, then create a policy with $1 million. And therefore, if you need long-term care, as you receive your $1 million from your insurance company for long-term care, $1 million is protected in the estate. So it's a legal way of protecting your estate without having putting your money or your home into an irrevocable trust. So let's talk types of long-term care policies. There's traditional, which are use it or lose it. These are the most cost-effective when paying annually or for less than 4 years of coverage. And the traditional policy is what is required for Mass Health lien protection. Sometimes people will get a very small traditional policy to fulfill that Mass Health lien policy and still get a hybrid. So you can mix and match these policies. Then we have hybrids with life insurance. These do have underwriting required of them, and it is still a pretty rigorous underwriting process. The nice things about this is that we have policies that have 0-day elimination periods. So as soon as you need care, you become eligible for benefits. Once you get to your 90-day, I should say, once you qualify, and it's paying starting on day one. So it's just a real feel-good policy, whether you go into assisted living or if you're staying at home. And then there are other policies that are cash. So if you say, gee, I think I might want to have a family member or a friend or a neighbor use my you take care of me, well, a cash benefit helps. And the hybrids have international coverage so that if you think you might be living outside the United States in your retirement years, then a hybrid with life insurance or a hybrid with an annuity makes a lot of sense. And a lot of people like to have these paid up before they retire. So you can put it up in a lump sum or over 5, 10, 15, or 20 years. And for those people who say, what happens if I never use it? There's a death benefit. Now, we have these newer hybrids with annuity chassis, which are still qualified long-term care policies, which means that the benefits are coming in tax-free. The nice thing about annuities is that they have much less underwriting because they don't take into consideration your mortality. They only take into consideration your morbidity. So if you have something that looks like it's going to, affect your lifespan, it's not going to be a concern with this type of product. And these can be very highly leveraged for those between the ages of 70 and 80. So oftentimes people will choose these hybrid annuities because of the way they're structured, and they actually have better returns than the traditional or the hybrids with life insurance. Now, we do have life with long-term care riders. I just put that in there to know that they're out there. A lot of companies like AA, and groups will offer life with long-term care riders. These are best for people under 50 who don't who are really looking for a death benefit first, and because it's just an acceleration of your death benefit. There's no inflation on these policies, and so I put that out there because so that you understand when somebody talks about a life insurance with a long-term care rider, it's not usually the best fit for people over 50 if they're looking for long-term care. All righty. So where are we on time? Oh, we are flying for time. So let me open up for questions. Does anyone have any questions?
I'm not seeing there's somebody in the Q&A just was commenting when they couldn't hear us. But hopefully that was resolved earlier. Linda, let me just ask you a question while others can type something in if they have questions.
Sure.
In our discussion about Medicaid, I often
Mhm.
have people who comment about wanting to spend down their assets so that they will qualify for Medicaid and want to be able to give everything to their kids. And then I also explain to them that there are look back periods that you can't just give it all away, 3 days before you apply for Medicaid. Can you explain that a little bit?
Yes, very, very important. So even more than the look back period is if you love your kids, you will not go on Medicaid. Okay. I mean, think about it. If you are in home care, we have home care agencies, private home care agencies. They pay their caregivers well, right? That's why there's 4-hour minimums. Our government hires people for home care and they give them 2-hour stretches. So they go from home to home to home to home, doing the hardest jobs of the day, bathing and dressing, toileting, bathing, dressing, toileting, bathing, dressing, toileting. So let me ask you, if you were an independent CNA, would you want to work for a private agency or the government? And of course, the answer is you're going to work for a private agency. So the question is, who's working for the government? And it's typically people who don't get jobs in the private market or people who don't speak English well enough to get a job in the private market or people who don't have uh, as good a reputation in showing up on time. I mean, I get calls all the time from people who have caregivers through government agencies. Very few of them are excited about their home care, and they'll often say to me, what are my options? And unfortunately, there are no options, right? So you want to be able to choose your agencies. You have no choices when you're on Medicaid. The other thing is that because there is not the consistency that you would have from a private caregiver in home care, that you so it makes it more difficult to stay at home with a government caregiver because you don't know if they're going to show up. And then we go into say, okay, let's go into assisted living. Assisted livings do not accept Medicaid. There are maybe two assisted livings in the state that accept Medicaid. And you can imagine that those assisted livings are using them for spend downs as opposed to welcome in, right? So what does that leave for our Medicaid population? It leaves them to go to nursing homes. Nursing home, sweet nursing home. It does not quite have the same ring, right? So the most important thing you can give to your children is the sense that you can take care of yourselves and they don't have to worry about you. If you are on Medicaid, they will worry about you and they should worry about you, unfortunately. When my aunt got sick in Florida, she came to me and said, help me find home care providers because you did so well for your parents. Well, my parents have a long-term care plan. I mean, the home care agencies were lined up for their business. And I called every one of those agencies and said, oh, no, we don't work with Medicaid. It's a whole different home care agency that works with Medicaid. So, regardless of the spend down, the concept is if you're doing this for your family to save money, spend the money. It's much, much, much more important that you get quality of care.
Okay, Linda, we have a couple of questions. The first is I'll answer, which is there going to be a recording on this? Can it be shared? And yes, it will be available on the 12 Points website, and we'll be sending something out to everyone who signed up for this about where to find that.
Great.
I have someone here who is a 43-year-old female with no children, single, and I'm looking to invest now for the event that I may need assisted living or something more. I am healthy, no issues, no comorbidities. What is recommended for someone like myself?
Yeah. So wonderful. Perfect timing. I actually got mine when I was 39. And for all you out there, I actually got it for my kids as soon as they were in college. And usually I tell people to start thinking about long-term care at 30, uh, unless you have kids engaged in very rugged sports that you may want to protect them. Because remember, it's not just if they need care, it's if they could prevent themselves from getting these policies later in life. Right. So great age to be looking at long-term care. Basically, you're healthy, so the world is your option. You get to choose anything. And basically, it's going to be comparing whether you want cash or whether you want a 0-day elimination period, and to help you decide whether or not you want to pay it over 10 years or 15 years, so that it could be completed by the time you retire. So lots of options, and and then we can just pick which one's best. So what I typically do is when I have all your information, I will go out to all the carriers in this constantly changing environment that we have, and I will make a table for you. And I can compare traditional policies and hybrid policies. And if you want international coverage, I'll identify which ones have the international. And if you want to make sure it has a death benefit, then everything's identified. And then we meet together on Zoom so that we can go through all of the options so you understand them. We fine tune that list so that you're not trying to study a dozen policies. And then I send it out to you to review and think about, ask questions. And then when you're ready, we can meet again, review, review, and review. And when you're ultimately ready, the application process is again done right on Zoom, and we bring up the link from the insurance company and complete the application online.
Great. One more question here. With long-term care benefits, are you allowed to choose your care providers or facility, or is that dictated with the terms of the policy?
Total independence. So you can choose any facility any home care provider, the limitations for some policies are that it has to be in home care a home care agency as it is defined by your state. Now, Massachusetts is a very liberal state. Our home care agencies are employment agencies. So literally, if you have a certified nurse's assistant, which is, I believe, an 8-week course, that person can say, I want to be an agency and call themselves home care agency number one, and then bill themselves as an agency to the insurance company and pay themselves. Completely legal, and approved by the insurance companies, because I have checked this out on behalf of a client. And so very easy to be an agency in Massachusetts. So in that case, yes, you can hire any CNA you want in Massachusetts because they could be an agency. In other states, you may have to be more careful to understand if they're certified or licensed or employment agencies in other states, and choose from those agencies, which there are hundreds in all of those compartments. The cash policies have no limitations, and many of the hybrids also have no limitations. So they say you can use an independent caregiver, you can use somebody from an agency, it's completely up to you. Now, the terminology for assisted living is a technical term, but the vast majority of these policies have what's called an alternative plan of care. So it says if there's something out there that is not identified in the policy, then you can still use that if the insurance company and your doctor agrees. And usually it's based on, fair pricing, right? So an example would be, I had a client who had dementia and did not want to go to assisted living. They wanted to go to a research facility for dementia. So obviously this research facility was going to care for them and provide them with the care and supervision they needed. And they had, the CNAs on board. So it worked as a custodial environment, and the alternative plan of care paid for that environment. So there's a tremendous amount of flexibility within these policies, even if they're not specifically identified. And the cash policies, literally, you can do anything you want, right? So, I mean, if you wanted to lie in bed and just stack up the money next to your bed, you could technically do that.
Wonderful. Okay, that's it for questions.
All right.
Please, I'd like to encourage everybody, take a look at Linda's site. That's at the www.longlifeplanning. And she's got good educational information out there about long-term policies. If you work with a financial advisor, talk with your financial advisor first, because they'll basically help you figure out how this fits within your financial plan. And if you don't, fill out Linda's long-term care questionnaire and get started with her.
Excellent. I look forward to helping anyone who wants to investigate their options.
Great. Yeah. Thank you, everyone, for coming.
Have a wonderful day.
All right. Bye-bye, everyone.